Good morning. This is John Richardson speaking with you from Toronto, Canada. Today is March the 12th, 2022. And my return guest today is Mr. James Miller, who is a financial planner for expats. And this, before we get started, is another podcast that is being done for the American Expat Financial News Journal, a leading publication and website on issues American expat finance. And really looking forward today to talk to Jimmy Miller generally about the problems experienced by expats, the solutions. And these things I think are largely covered in his book. And we'll begin with his book is Divorce the IRS, How to Defuse Your Biggest Tax Time Bombs Before You Retire. And I gather that he's not saying really divorce the IRS. He's saying run your financial life in a way that the IRS isn't going to make any difference in your life when you retire. Welcome, Jimmy. How are you today?
Great. Thanks for having me.
And is that a good way of describing it? Organize your life so the IRS is not a factor in your life when you retire?
It is possible actually to divorce the IRS on the same day you retire and never pay any income taxes again if you do the correct planning. But the overall arching theme is to pay the least amount of tax to the IRS as possible over the course of your lifetime, not in just in any one given year.
Okay. Now, this is as fewer and fewer people in life have company pensions, and although U.S. Social Security is fairly generous, I wouldn't say the equivalent plans in other countries, for example, Canada Pension Plan, are as generous. I have come to see that individual financial planning is critical. I think it's a personal responsibility for yourselves, your families, and it is becoming increasingly more important. You would agree with that?
Absolutely. And especially if you're in a unique situation like being an American overseas or married to somebody of a different nationality and having a cross-border family, then it's even more important.
And yet at the same time, there is so little education in this area, both about the necessity and how to do it, and also so few people who actually focus on this as a problem. Presumably you would also agree with that.
Absolutely. There's not many people out there that are focusing on helping people in this situation for sure.
So you're well positioned. Well, let's go back maybe to some first principles here. I mean, this may sound like a completely idiotic question, but I think it's probably a good place to start. What's the purpose of financial planning anyway? Why are you doing it? What's the goal?
Well, it's to have goals, to reach your goals. There's a lot of people who just wander through life and they're not really sure where they're going to end up. And there's other people that decide where they want to end up and figure out exactly what they need to do each year to get to that destination. I'm definitely a goals-based person. If you listen to the other podcast, you've definitely determined that by now. And so I help people with exactly that, figuring out what their goals are and how to get there.
So you would agree, I think I saw this on a bumper sticker, some people fail to plan, or if you don't fail to plan, you're planning to fail. Is that how this goes?
That's exactly right.
All right. So planning, the earlier you start, the better, clearly. There's no question. Would you advocate teaching financial planning like right from junior high school or earlier?
Absolutely. And like many people, I'm shocked still that we don't really teach it, at least in the American educational system. We don't teach finance nearly enough, what investing is, the difference between stocks and bonds, even how to balance a personal checkbook. Not that many people use checks anymore these days, but there just isn't a lot of education out there on the subject of financial planning.
Well, how is this even possible in a world where this is just so important? I mean, why isn't this a requirement to get a high school diploma, at least some basic financial literacy?
That's a really good question. And you can go down a rabbit hole with that. There's definitely people that believe that it's designed that way to keep people in the dark and different political motives and things like that. So without getting into all those political things, I just would say that it's sad that we don't provide that education. Now, at the college or university level in America, we do now have that education. There's numerous colleges and universities now that are offering bachelor's and master's degrees in financial planning to prepare people to become good financial planners as a career in life. But we just don't have it in the lower education levels in America yet.
Now, you mentioned a few minutes ago that, I mean, sure, you want to have the you want to avoid having the IRS in your life when you retire. But you also made the obvious point that you want to be able to minimize taxes as you go along. When I look at financial planning, um, it seems to me there's different financial principles in different countries, which are largely dependent on the opportunities available under various tax systems, right? Or let me put it another way. Would you agree with me that uh, tax systems are about far more than collecting tax? They're about facilitating financial planning and retirement planning.
Absolutely. I mean, taxes are different in different countries around the world. Progressive taxes, flat taxes. In Russia, where I just moved from, they had a flat tax. Everybody paid 13%. Whether you made $10,000 a year, $100 million a year, it was a 13% flat tax. Where here in the United States, along with most countries in the world, we have a progressive tax. So the more you make, the more tax you pay. But taxes in general are quite the same in many countries around the world, and how they work, the kind of tax breaks that people can get. The taxes are a good way for the government to incentivize people to do certain things. If you want people to, say, buy life insurance and own a home, then you can give tax breaks for those things. And that incentivizes large swaths of the population to take advantage of those things.
So, for
It's
example, the deductibility of mortgage interest in the United States.
correct. Exactly. Exactly. And that's universal across the world. And it's also universal across the world that there are financial planners and tax professionals that specialize in financial planning to help people reduce their tax liability. I've never met anybody, no matter how patriotic they are, that tells me, you know what, I just love paying extra taxes. I want to help my country by paying extra taxes.
Surely
Um,
you're kidding me. You've never met somebody who said that?
Still looking for that person.
Okay. All right. So, I mean, when we look at the role of tax systems in financial planning, I mean, we could probably pick any country, but since, uh, you're primarily a financial planner for, I think, American expats, right? We look at the American tax system, things like 401ks, IRAs, et cetera, are, they're government mandated plans to encourage and facilitate retirement planning. Um, from first principles, how are those designed to work?
So outside the Social Security system, which is our old age pension scheme, there isn't really much that's mandated by the government in America for retirement savings. The government here tends to leave that up to the citizens' responsibility to save on top of the Social Security for their own retirement. Now, certain companies have also retirement programs. Some make it totally voluntary, and other companies mandate that their employees participate in it to help them with their financial future. But as a general rule of thumb, besides Social Security, most programs in the United States are totally voluntary.
Okay. So, and how do these programs interact with the tax system? How does the tax system incentivize these kinds of programs? So let's start. Maybe you could describe a basic 401k, for example.
Sure. Well, to break it down one step before that, there in America anyway, and I think in most countries actually, there's basically three different tax buckets or tax types of investments. In bucket one, we have what I call the tax me now bucket. These are investments that as you earn money in them, you have to pay taxes now or this tax year. So money in a savings account or a regular mutual fund account, if you make an interest or a profit, you have to declare that and pay taxes on it. That's the tax me now bucket. Now, in order to incentivize people, most countries, including America, have what we call a tax me later bucket. And these incentivize people to put money into investments because they don't have to pay any taxes on them now. They have to pay taxes later. That's called the tax me later bucket. Now, these are the most popular programs around the world, including in America. And these give you what most people would say is a tax deduction or a tax break now in order to tax defer till later. In my book, and what I argue is that you're not really getting a tax break or a tax deduction. What you're really doing is taking a loan from the government or the IRS in America. And because it's not really a tax break or deduction, it's just taking the tax and putting it off till later. You're not really getting rid of the problem. You're just putting it off till later. So these accounts work. You put money in, you don't pay any taxes on that money now. So if you make $100,000, you put $10,000 in one of these programs, you only get taxed on $90,000 of income for that year. Thus, the $10,000 you put into the program has never been taxed. Now, it will be taxed when you take it out. And one of the big problems is, and I think the reason the government set this program up is, of course, you hope that money will grow. So that $10,000, by the time you take it out, say in retirement in 10, 20, 30 years, depending on your age, that $10,000 might be 20 or 30 or $40,000. Now, was it really a good deal to save the taxes on the 10,000 originally so that you could pay taxes on the 40,000 that you take out down the road? Well, that takes some serious financial planning work to determine in your situation if that was a good deal or not. But I can tell you, just as it sounds, that for most people, that's not a great deal. But people like those tax deductions now, and they just put those problems off to later. The third bucket is the tax me never bucket. Now, that's a fairly new bucket. It started in 1997 with the enactment of the Roth financial accounts in America. And these accounts allow you to put that $10,000 in, but you don't get that tax break or that loan from the IRS up front. You put the $10,000 in after tax, but then it grows tax free. I like to look at it like a farmer. You can choose to pay taxes on the seeds at the beginning of the season. That would be a Roth IRA. And then when you harvest in the fall, it's all completely tax free. Or you can forgo paying tax on the seeds in the beginning of in the spring and then pay tax on the entire crop that you harvest in the fall. That's the difference between those two buckets, the tax me later and the tax me never bucket. I encourage people to start looking and doing financial planning to figure out if the tax me never bucket is in their best interest. So they put that $10,000 in, and by the time it grows to that $40,000 down the road, they can take it out completely tax-free.
Well, this is a great description of this stuff because I think it breaks it down very well analytically. But also, I've never heard things like 401ks or RRSPs, for example, in Canada, really described as tax deferral vehicles. They're always described in some other way, but when you put it that way, right? I mean, obviously, as a general principle, you're probably better off deferring taxes. But the point is that you are just that. The tax thing does not go away. You're basically deferring it. Hence the popularity of the Roth IRA, or in Canada, the TFSA. Now, I received a newsletter a week or two ago from a tax person, actually, who, in one or two sentences said, what if you invested $25,000 in a Roth IRA at a very young age? What would be the result of that?
The result with compounding interest would be quite spectacular. I mean, Einstein said compounding interest is one of the miracles of the world. But in order to get compounding interest, you need time. So, of course, the younger you start in life, the better, the more compounding, right? You want that $10,000 to turn into 40 or 50 eventually, not just into 15 or 20. It takes time for that to happen. So the earlier you start, the more benefit the tax-free accounts are going to be for you, for sure.
All right. Now, what are the requirements, for each of these three things? And to remind listeners, I think this is a great way of putting it. A tax now, tax later, tax never. Correct? Now, The tax now is presumably it's your money, do with it what you want. There's no tax implications other than the return on the investment, correct?
Correct. So the tax me now is exactly that. Just the growth and the interest of the account is
Well, give me an
taxed.
example of that, a practical visual example. Just opening a brokerage account somewhere.
Just opening a brokerage account, just saving money in a savings account at the bank.
Okay. Now, why would somebody do that if a Roth IRA is available? I'm having trouble understanding why somebody would actually do that. So somebody has $10,000, in their hand. They have a choice of opening a brokerage account, tax me now, or putting it into an IRA, tax me never. Why would they not just put it in the IRA?
That's a great question. And there is a purpose for each bucket for sure. So none of the buckets are bad. Now for the tax me now bucket, this is for like an emergency fund. This is for the money you're saving for that down payment on the house or to buy that next car. The tax me never bucket and the tax me later bucket are both retirement type buckets, and they come with stipulations. In order to get that special tax treatment by pushing the taxes off later or never paying taxes, you have to leave that money in the account for a certain period of time. The general rule of thumb is age 59 and a half in America. So the reason you wouldn't put it in that Roth IRA if you were, say, 25 years old, and you needed that money before you're 59 and a half would be because you would be locking it up till age 59 and a half.
So in other words, just to preserve the right to use the money. That's the only,
Correct.
is that the only reason?
That's the main reason. So you want to balance out your buckets, right? So you need to have access to money for an emergency, for that down payment on a car or house, things like that. So that's the appropriate use for the tax me now bucket. And then the other two buckets are generally used for retirement, long-term money.
Okay. Now, the bucket two, the tax me later, this would be a traditional company pension plan?
Correct. A pension plan, a traditional 401k, an IRA, those are the things that fall into that bucket. This is the most popular bucket. And the reason is because people like instant gratification. One of the big things all around the world that people like is instant gratification. So if you can put some money in an account and you can get an extra $500 tax return on your tax return this year, people will do that. People, they don't think long term in a lot of cases, and they don't say, am I hurting myself in the long run to get this extra $500 this year? They just think, oh, it'd be great to get an extra $500 this year.
Well,
I
don't think that they know enough about this to think about how that could hurt them in the long run.
Correct. And we have a whole industry that is pushing the tax me later bucket. We have a whole, taxes have become so complicated in America, as many places around the world, that a lot of people hire a tax professional to help them with their taxes, a tax preparer or a CPA.
Is a tax professional a financial planner?
Generally not. So I don't prepare taxes. I help with tax planning and lifetime tax planning, but I don't actually prepare taxes. There's a whole industry of tax professionals that specialize in just preparing taxes and filing taxes.
I've heard of that. I've heard of them.
Now, the problem with that is if I'm a tax preparer, I want to make my clients happy. I'm running my business. I want to make my clients happy. And generally the way a tax preparer or a CPA makes their clients happy is to get them the most money back so that the person pays the least amount of taxes. And that intuitively sounds like it makes a lot of sense. Hey, if I could show you a bunch of things to pay the least amount of tax this year, would you like it? Who's not going to say, oh, that sounds great to me? The problem is these tax professionals are damaging people in the long run by giving these short-term instant gratification, basically loans from the IRS to lower their taxes today by just pushing all these tax problems off till tomorrow.
Jimmy, can I put it this way, just in really simple terms? What you're really talking about, it seems to me, is identifying when it makes sense to pay tax now so that you'll end up, so that you don't pay it later and will end up better off, correct?
Correct. But it gets more complicated than that, because it's not just the issue of what you're going to pay in tax, whether you're going to pay the tax today on the $10,000 or tax later on $30,000 or $40,000 once it's grown. By deferring the taxes, you set yourself up for several tax time bombs, which I outline in my book.
Okay, just hold there for 1 second. I think I know where you're going with this, okay? But before you continue, the point is that I think where you're going is that with the Roth IRA, when that money is distributed, there is no tax paid. It is not taxable income, correct?
That's absolutely correct.
But with
Not only is there
other
no tax
stuff,
paid,
it is taxable income. And the more income, the higher the tax bracket, correct?
not only the higher the tax bracket, but the extra taxes that you trigger, the time bombs I talk about in my book.
Okay, continue from that point then.
So a perfect example, Social Security, everybody knows about it. Everybody's looking forward to getting it one day. We get this benefit by paying taxes. Polls show that about 50% of Americans don't even realize that Social Security is taxable. It's something you paid with taxes. How can they then tax it on top of it? Well, they do. In America, there's certain thresholds. If your income is above a certain threshold, then you have to pay taxes on your old age Social Security pension as well. And the thresholds are not that high. This is a good example of a tax time bomb. So you can start Social Security in America as early as 62. You can wait till as late as 70 to start it. The longer you wait, the more the money is going
By
to
the
be
way,
available.
do you have a recommendation on that as a general principle, early or later?
Later, generally later. Financially, it's most people start it too early, and they would do better to wait and get the bigger check.
And very quickly, the reason for that,
The government has guaranteed growth. So every year that you wait past full retirement age, your Social Security goes up by 8% guaranteed.
that's an unbelievable return.
It's an unbelievable return. And of course, the cost of living adjustments on a higher check escalate and compound faster over your later years than starting from a lower base, a lower check.
And that would
The other
carry over to spousal benefits too, right?
Correct. The other reason is when one spouse passes, which unfortunately there's almost always one spouse that passes first, the surviving spouse, which is usually the woman statistically, inherits the larger Social Security check. The smaller one goes away and they go to the larger one. So if you've waited and you have that larger check, the surviving spouse is going to get a better benefit for the remainder of their life as well.
So it's really, so the delay really should be viewed, at least for married couples, as a form of financial planning for the surviving spouse.
Absolutely. Absolutely. Now,
Okay.
there's an art and a science to financial planning. I like to tell that to people. So, some people, I can show them mathematically why waiting till 70 makes the most sense and they'll get the most money back from the system. But that's only one half of the equation. You do have to factor in the art of financial planning and admit that, a dollar at age 62, when maybe you're still healthier and can do that international travel and world trip that you want to do, is more valuable to you than the dollar when you're 75 and maybe don't have the energy or the health to do the kind of things you want to do in retirement, right? So you have what I call the go-go years, the slow-go years, and the no-go years in retirement. So as a financial planner, it's one thing to show mathematically what's best, but you have to factor in the art of financial planning and help people understand. And I have to understand what's important to them. So oftentimes, maybe starting that Social Security earlier because the value of those dollars, even though there's less dollars, is more valuable to their goals to start earlier in life when their health is better.
But, okay, so back to the bucket three, the tax me never versus the bucket two, tax me later. The point is that as a general principle, Social Security payments are taxable, correct?
If you get above a certain threshold. So this is a perfect example. If you only get Social Security, if you haven't saved any money in America and you only get Social Security, it will be tax-free for you. The government does you a favor because, to be honest, Social Security isn't that much money. The average Social Security check in 2021 was only a little over $1,700 per month. So it's a pretty meager living and there's no taxes on it if it's just that. But if you have saved diligently or you're going to get a pension and you're going to have income on top of Social Security, you can reach the taxable thresholds quite quickly. Now, for a married couple in America, the first threshold is at $32,000. So if you have income above $32,000 on top of your Social Security starts to become taxed. Half of it becomes taxed. By the time you get to $44,000, 85% of your Social Security becomes taxed. So if you save that $1 million in a pre-tax 401k, good on you. That's a great savings account. But if you go and take $50,000 out of that for retirement income, you're not only going to now pay taxes on that $50,000 you took out, because right, you got that tax break originally, you pushed that tax to later. You're also now going to trigger taxes on your Social Security. So 85% of your Social Security is now going to become taxable. Now add those two taxes together, and that's a whopping tax time bomb for somebody. The average married couple in America pays who breaks those thresholds, pays about $5,700 a year out of their Social Security in taxes. Now, had that person just saved that $1 million in the Roth IRA or that tax me never bucket, they'd be able to take out that $50,000 without any tax, and it wouldn't even show on their tax return. So their Social Security would then be tax-free. That person now has truly divorced the IRS. They have $50,000 out of their Roth tax-free. Now their Social Security, because they don't breach those thresholds with the Roth IRA, is tax-free. Every penny they have in retirement, completely tax-free.
Yeah, that's very, very well explained. I mean, just on a very, very pragmatic level, don't you think that part of financial planning, when we talk about this, should actually be to run some actual hypothetical tax returns to show people this stuff? I mean, I don't think people get this.
They don't. And most financial planners, to be honest, don't get it either. So I tell people, if you're a financial planner, and to all your listeners, if your financial planner has never asked you for your tax return and they're not doing tax planning as part of your financial plan, it's time to find a new financial planner. Let's be honest, you pay a lot of taxes over the course of your lifetime, no matter what country you're living in. And if your financial planner isn't helping you mitigate those taxes and make a tax plan for your lifetime, they're not being a comprehensive fiduciary financial planner for you.
All right. Now, I agree with you completely, but you mentioned other countries, and I'd like to move the discussion a little bit to the problems of being an American abroad. Um, with the problems are numerous. How do you help individual Americans abroad think about these problems? I mean,
That's a great question.
obviously, there's a lot of, there's a whole overlay of additional problems, particularly since many of them do not get U.S. Social Security, or at least they haven't, set it up that way. They don't have 401ks. They don't have IRAs, particularly if they use the foreign earned income exclusion, right, which means they don't have any, income, etc. They're living somewhere outside the United States. They're thinking they might want to come back. Take me through how you would counsel somebody in that situation.
Well, every situation is unique, but you hit on some really key points there, and not just for Americans, for expats in general. When most people leave their home country, besides the United States, which has citizen-based taxation, as I'm sure your listeners are well aware of,
I don't know that.
they get themselves out of the taxes and thus the Social Security for their country. People who want to live and work overseas have to understand that they're not putting into their country's home pension scheme like Social Security. And they have an extra responsibility as an expat to make that up. One of the biggest tax bombs or retirement bombs that I see for expats is exactly that. They haven't taken into account that they're not paying that tax in their home country, and they're not getting that benefit. I know a lot of Americans that went back quite late in life back to the States to realize that they had no Social Security benefit, and they hadn't planned on that or saved enough to overcome that. And they put themselves in a really bad situation. That's a big financial planning issue for expats for sure.
Well, it seems to me that in many cases they simply can't go back, because of these problems, right? I mean, I'm thinking of the ones whose financial planning is, completely integrated into the tax systems of other countries. But there's another issue with this, is that the US tax system makes it very, very difficult to use the normal financial planning vehicles in other countries. For example, we've been preaching the virtues of the Roth IRA, and I agree with you completely. In fact, I think a Roth IRA ought to be described as a tax haven. I think that would make it a lot more attractive for people, right? So, if you're in America, you have the Roth IRA. There's a similar plan in Canada called the TFSA, a tax-free savings account, Where if you're an American in Canada, the consensus, I'm not sure I agree with this, but the consensus view in the tax world is that the income inside that TFSA is subject to US taxation, if you can imagine, right?
Correct. Correct. So you definitely have to take that into account, right? So if you're going to be living in Germany, for example, a Roth IRA might not be so beneficial to you because Germany is not going to recognize that as tax-free. And when you take the income from it in retirement, if you're a tax citizen in Germany, you will need to pay taxes in Germany on any growth in that account. So that's what I help people with, is untangle all those tax cobwebs that they've built for themselves. Every situation is different, whether you're married to a citizen of another country, whether you plan to just stay in that country for a certain period of time or stay there permanently, all makes a big difference. How you file your taxes as an American citizen overseas, whether you use the FEIE or the foreign tax credit approach to your taxes, determines what you're eligible or not eligible to do as far as saving for retirement within US-based retirement tax programs. Whether you can do a Roth IRA or a backdoor Roth IRA, or if you have a US-based income, so you can set up a 401k or a Roth 401k in the States. Every situation is different. I help people untangle that.
Would you agree with the following statement that I'm about to make? All right. But using the foreign earned income exclusion is possibly very dangerous to your financial planning.
Absolutely. Absolutely. That's a very accurate statement.
Okay,
It
I wonder if
disqualifies
you would elaborate on that. As a find that nobody listens to me. What do I know? Okay, so why don't you elaborate on that and your role as financial planner?
So it depends what country you're living in and what the tax scheme is in that country, whether the FEIE or the FTC is more beneficial to you. The FEIE, the foreign exclusion, is definitely the simpler program and what most people and a lot of expats use, because it's quite easy to just eliminate your most or all of your income and not pay tax in America on it with that system. But that also disqualifies you then from contributing to the Roth IRA or even a traditional IRA unless you have other US sourced income. So this definitely creates a problem. Now, many people believe that, well, I'll just use the programs in the country that I'm living in, or they get talked to by a financial advisor that's not an expert in this situation, and they get talked into PFIX or some of the insurance schemes out of the so-called tax havens of Malta or Cyprus or things like this. Now, this creates an even bigger tax nightmare, especially for US citizens, as you're probably aware, and a lot of your listeners are, because you're purchasing what's called a passive foreign investment company, or a PFIC. And the US is not tax favorable to PFIC investments at all. They're not illegal, but they are very tax arduous, and with the paperwork reporting, and the taxes on them are also very they penalize you for having these type of investments. The US is trying to avoid American citizens placing their money overseas to avoid that US based taxation. And they've done a very good job at creating a complex tax law that does exactly that. So that's another tax trap that I see a lot of American citizens overseas that I run into who are seeking out my help. They've invested in these type of programs overseas and created a real tax nightmare for themselves.
So, the PFIX, I mean, basically the way I see it is that the US is very hostile to anything foreign, and they're either going to attack it under the CFC regime or the PFIC regime. And what would you advise people in terms of simple investments that they can make outside the United States that don't attract either of these kinds of problems?
So for most Americans, the best choice is going to be to keep their money and their accounts inside the United States. The United States is the biggest, largest, most regulated, and most liquid financial system in the world. Now, that doesn't mean you have to buy American investments. I can build a portfolio. If I meet an American living in Germany who loves Europe and doesn't want to have anything to do with America, I can still build a completely European-based, euro-denominated portfolio in an American brokerage account through, say, Schwab or Pershing, and buy ETFs that have only European companies, only denominated in the euro, for less expense than they can do that in Europe. And that's because of the size of the American financial market. Everything that's traded around the world is also traded in America on the New York Stock Exchange. And you get a lot of protections in the American financial system and liquidity as well. A lot more shares are traded on the New York Stock Exchange than any other stock exchange in the world. So I think to finish answering your question, if you're an American citizen based overseas and you're using FEIE, you still need to save for your future. You're just restricted to a basic tax me now brokerage type account. Now, you can invest in whatever you want inside that brokerage account, but you're going to do your best to use a US based brokerage account, even if you only want foreign and other currency denominated assets. And you're just going to have to face the fact that you're going to have to save a little bit more based on the fact that you're going to have to pay taxes on your growth every year. And that's going to eat away at that compounding over time versus one of the other buckets where you don't have to pay taxes each year on the growth in the tax me never or the tax me later bucket.
Right. Now, there are certain treaties, unfortunately, as you know, there's none of these treaties are really the same, but there are certain treaties where certain kinds of retirement planning vehicles are sort of given treatment such that they can be used for tax deferral, et cetera. But, this is not true right across the board. I mean, do you have any thoughts on the countries that have the more favorable tax treaties for retirement planning versus the ones that are horrible?
Yeah, every country is different. Every treaty is different, just like you mentioned. But there are treaties in place. Most of the treaties are designed to eliminate double taxation. They're not designed specifically to recognize specific tax treatment of specific accounts, like the Roth is tax-free, for example. They're really designed to eliminate that double taxation between the two countries so that you don't get double taxed. The totalization agreements on top of the tax treaties are designed so that if you're paying into a Social Security scheme in one country, it's somewhat portable to another country. And a lot of people are very confused by those agreements. And that's another one of the things that I help people figure out. It's hard to give a broad stroke answer here. Like you said, every country has different laws, different tax treaties, different totalization agreements. But in general, that's what they're designed to do, is eliminate that double taxation and make it so that if you are putting in Social Security tax in one country, you don't have to do it in two countries at the same time and get double taxed, and that the credits will help you in the other country.
Right. Well, what I'm getting from this is, I think a couple of general principles, right? The first is that financial planning is, at this stage in history, absolutely critical for people, correct?
Yes, and even more so for people who would venture outside of their home country, and then double down on that for people who fall in love and get married to a cross-border spouse.
Yeah. So the second principle is that, as important as it is, it's a lot harder if you want to live outside the United States.
It's definitely more complicated. Yeah, I guess I would use the word harder as well. That it's definitely more complicated, and you have to take more things into consideration in order to reach the goals. Most people went overseas for an adventure, but they also have certain goals, and there's a lot of financial rewards for going overseas. There's some really great salaries and packages and things like that. But if you don't take the time to put a financial plan around all of those benefits you're getting from living overseas, you might end up in the end just having the adventure and not getting all the other rewards that you expected to get.
Or you'd be in a position where not only does the government punish you, but you're punishing yourself as well, right?
Absolutely.
Creating sort of the perfect storm. Well, Jimmy, this has been a really, really good discussion, and I appreciate this. And I think that you have very effectively demonstrated the importance of finding a financial planner who works with Americans abroad or expats generally. And to that, I would add, this works the other way. People moving to the United States, moving to Canada. I could tell you horror story after horror story of people who haven't thought about the implications of this from a tax point of view and find themselves in tremendous difficulty after they make that move. I really like your book, Divorce the IRS, how to defuse your biggest tax time bombs before you retire. I really would recommend it to everybody for two reasons, or at least two reasons. One, it's a great book. I mean, you go through the tax buckets that are really at the core, which is tax me now, tax me later, or preferably tax me never, not at all. But the other thing is that it's short. And simplicity is virtue, as the saying goes. I mean, I think somebody could actually read this book in an afternoon, no problem, and be in a better position because of it. To learn more about you and your book, what are your coordinates?
So the book has a website itself. It's divorce-the-irs.com. And you can find more information about the book, how to get it on there, as well as some financial calculators that you can use for free on the site on how to figure out some of these numbers for yourself. I also a chapter in the book specific to US expats and all the problems that they face. And as you mentioned, people that are expats in America as well. I'd like to help those people as well. And there's a whole chapter in the book for those that are seeking adventure and being expats here in the United States. So the Tax Me Never bucket, the Roth IRA, is one of the key things for expats that come and live and work in the United States as well. I find a lot of them come to the United States and get overwhelmed by this new financial and tax system here, and they end up making the wrong choice, like a lot of expats do, and they get taxed and penalized heavily when they leave America eventually, and they want to take that money home with them. There's definitely ways to mitigate that and make sure that their time here in America is as financially rewarding as they hope it could be. And so there's a whole section of the book also based on that.
Great stuff. Great stuff. Okay, and your website is, and your phone number, website and phone number to get people get in touch with you.
Yep. You can learn more about me and my firm at my website at baobabwealth.com. Baobab, like the tree of life from the Lion King, baobabwealth.com, or baobabwealthabroad.com if you're living overseas. There's also some guides and resources on the website specific to expats, both in America and outside of America. You can also reach me by calling me on my US-based number at 907-317-8454. And you can email me at j.miller@baobabwealth.com.
Well, that's fantastic. And I am John Richardson. I'm speaking with Jimmy Miller, who is a financial planner for expats on behalf of the American Expat Financial News Journal. Thank you very much, Jimmy. This has been a great discussion.
My pleasure.